Hi there and welcome to The Money Movement. Today we're going to be talking about mortgages. So mortgages are used to buy a home if you don't have all the money to pay it off in one go, which most people, let's face it, don't. So how does it work in practice? Well, you can put some money up to buy a house. You can usually put a deposit down, but you don't have all the money. So what happens is the bank or the mortgage provider step in to pay the rest off, and then you pay them back. It simply means that these people who are selling the house can get on with their life, or the builder gets the right amount of money for the house, but you can move in despite not having all the money to do so. So we're going to run through four main things today. We're going to run through how you get a mortgage and the basics of that, what a mortgage is, the different types you can have, what happens when you're paying your mortgage and what you have to do to keep it going, and what happens when you sell your house and eventually move on. A mortgage is simply bridging the gap between your deposit and the cost of the house. So let's make it simple. Let's say we're talking about a £300,000 house. You can maybe have a 10% deposit, but if that's all you've got, where are you going to find the other 270,000? You can't buy much of a house with £30,000. So a bank or a mortgage provider steps in and will bridge the gap for you, and then you pay them back that £270,000 over a specified term at a specified interest rate. So that's what a mortgage is. It simply allows you to buy the whole house, even though you've only got a little bit of house to put down as a deposit. So moving on then to how a mortgage works. There are three main parts to a mortgage. It's the term you borrow the money over, the product you're on, which will affect the interest rate. Now, before I go into those three, I recommend that you get a mortgage advisor, and I tell you this from the bottom of my heart because I went to Lloyds, who I'd banked with all my life, and asked for a mortgage, and they said they would lend me £65,000, which would not buy anywhere near the sort of property that I needed to get on the ladder, so it wasn't helpful in any way, shape or form. But if you go to a mortgage advisor, they will be able to point you in the direction of a more suitable provider for your needs. So there are providers that like first-time buyers, there are those that are like older applicants, there are those that are happy to take on people with debt, those that are not. So go to a mortgage advisor and they will advise you on which provider is best for you. They make a formal recommendation saying which provider is better, based on your circumstances, which product's better, the interest rate, the payments, and they hold your hand through the process. It's a really complicated process. No one makes it easy. It's hard to deal with solicitors, it's hard to deal with product providers and mortgage providers and builders. And this all comes together and it's really confusing and, to be quite frank, stressful situation, and a mortgage advisor can really just help hold your hand through the process. Good thing about mortgage advisors is often their fee is put within the product, which means you don't have to pay it out of your own money. You can choose to do so. That's between you and them, but they will make it quite clear how much they're charging at outset, and you can decide whether or not to proceed. But I would highly recommend it from the bottom of my heart. I'm going to pop a link in the show notes below to a website called Unbiased, which will help you find a mortgage advisor near you. You can go see how they are, have a cup of tea, and decide if you want to use them or not. So on to mortgages and what products mortgages offer. The main three things that change are the term, the interest rate, and the product. Term, how long you have to pay back the money over, right? So let's say you lend me £120 and you say, Ali, I would like that paid back over 6 months, please. Well, I'm going to have to shift out £20 a month to pay you back. Let's say we do it over a year, well, that's £10 a month, right? Same with mortgages. If you borrow the money and pay it back over 10 years, your payments will be much higher because you're paying it off much sooner. Much higher payments, you pay less interest over the long term because it's done in that 10-year sprint. Most people go for a longer term, so let's say you go for a 35-year term. That means your payments are much lower, but the interest you pay overall are higher. But it's all about that affordability. How much can you afford to pay per month? There is no point overstretching yourself to pay for a house if you can't afford it, because you'll end up in trouble later on. It's also worth noting that if you ever stop paying your mortgage, the loan is secured against your house. The provider will simply take your house from you, sell it, and you will be left without a home. Moving on from that, term makes a big difference to how much you pay. The other thing is interest rates. Now, there are three types of interest rate you can have. The first one is a standard variable rate. This is set by the mortgage provider, usually a lot higher than comparable products, which means the mortgage is more expensive. People tend to fall onto standard variable rates by accident if they do not keep on top of their mortgage admin. I'll come on to that in a second. The second one is a tracker rate. This tracks the Bank of England base rate, as it's known. The interest rate in the economy will go up and down with the lending costs across the economy. It's a very cheap rate and it will move up and down in line with the interest rates, but it means you don't really have much certainty over your payments. Neither do you on the standard variable rate. They can go up and they can go down. What is the final one? Well, it's my favorite. It's the one that I've personally used. It's a fixed rate. So this means that you guarantee the cost of your mortgage for a certain period of time, which can be a good and a bad thing. So let's say you decide to go for a 2-year fixed rate like I did. It means that I know for the first 2 years of my mortgage, my monthly payments are going to be exactly the same because the interest rate is fixed. After that, I will move on to the standard variable rate unless I go and remortgage and get a better deal. That is what you should do because there is always better deals out there to keep your payments as low as possible. So you can fix over 2 years, over 5 years, over 10 years, 25 years, anywhere in between. And it all depends on your preference. If you want to make sure you know forever how much you're paying, do a long fix, but bear in mind there might be some penalties to pay if you sell the property before you've finished your fixed rate. The other negative is, of course, if you fix your rate at, let's say, 2% and interest rates in the economy fall, you're still paying a higher interest rate even though the market rate is now lower. So that's one thing to be wary of. Then pros and cons to every mortgage contract. Your advisor will be able to look at your circumstances and tell you which one is more suitable for you. How a mortgage works, what happens when you start paying it. Let's move on to how you get a mortgage. What impacts the amount you can borrow, because that's what it's about. You're borrowing money to buy a house. How much can you borrow? Well, so the first one is salary. The second one is your expenses and your spending habits. And the third one is your credit score. So first one, salary, you can't really do much about that one, but if you're on joint incomes, it's a little bit easier than if you're on a single income. But what this is how much you earn. So the more you earn, the more they assume you can pay back, and therefore the more they'll lend you. That's an important factor, how much you earn. The next thing is your expenses. Now, this isn't like the mill deal at Tesco. This isn't cinema with the friends. It's generally your contractual agreements, things that you have to pay no matter what. So this is stuff like student loan, pension contributions, most notably for people nowadays, car payments or credit card payments or any overdrafts or loans you have to pay back. It can really impact your spending. So for example, I'll lay my cards bare. When I went to get my mortgage, Nationwide knocked £40,000 off the amount I could borrow because of my car loan. So even though I could afford payments that were higher with my car loan, they have an issue about affordability and therefore they will not lend you the money. So if you're thinking of getting a new car and getting a first house, I'd highly recommend that you move around your commitments so that you maybe take up those commitments after you've got your mortgage, if only for budgeting purposes so that you know where you are. So the important thing is not having a lot of credit commitments and having a high enough salary to quantify the house you want to buy. Last thing is your credit score. This one's super important. So we're going to do a full video on credit scores, but it is just the footprint. It's your carbon copy life in credit form. So how good a person are you in real life? Well, your friends will be able to tell you that. I can't, but how good a credit score do you have? Well, Experian or Nodal can tell people that, and it is based on how much credit you have outstanding, your repayment history, this, that, and the other. I cannot recommend enough that you check your credit score. Go, and if you do one thing today, check your credit score. I'm going to drop a note on the show notes below showing you how you can do this for free, but it will show you if you have any credit that's outstanding. A lot of people get to a mortgage and they get denied a mortgage because they have a credit commitment that they're not paying. They didn't even know they had. This might be a TV you no longer have, something you thought you cancelled which you never did. You changed bank accounts, it didn't move with you. You've moved house, you're still paying for old bills. It can always be pulled up in the credit file, so just make sure you're squeaky clean on there and that you're a good credit customer. And if you're looking at building up your credit score, we cover this in the video, using responsible credit like putting your spending on a credit card and paying it all off is the way to do it. So hopefully that's given you a new flavour on what a mortgage is. Hopefully it's simplified it a bit more. So the main thing is you put a deposit down, they foot the rest of the bill. In exchange for that, you pay them regular monthly mortgage payments that depend on the term you borrow the money over, the interest rate that's applied, and the product. To make sure you get all three of those right and you get the right lender, I recommend going to a mortgage advisor, which can be found by Unbiased, which I'll drop the link below. Once you're paying the mortgage, make sure you do keep paying it, because if not, they can take you home and make you homeless. And the last thing is that when you come to sell your home, you eventually will receive money from another mortgage provider to clear your loan, and you then have a bit of free money to go and buy another one. So the main thing is make sure you get a mortgage advisor to talk you through the best products for you. Make sure you haven't got a load of credit commitments that could restrict the amount you can borrow. Think carefully about your credit score, make sure that's squeaky clean and is continuously rising, and make sure that you can budget enough to pay your mortgage and payment, because it's really important that you do so to keep your life nice and stable. So as always, if you've got any questions, please drop in the comments. We'd be really keen to hear what you guys think and what you guys are struggling to understand about mortgages, and we'll help answer the questions. So yeah, until next time, you take care. next time, you take care.